Welcome to mindyourinvestment.com. My name is Siddharth, and in today's video, we'll talk about technical analysis part 3. So in the first video, we spoke of the introduction to technical analysis. In the second video, we explained the pricing of the stock. And in today's video, which is the most important video, we'll talk about the trend of the stock. Trust me, if you learn today's video properly and with proper focus, you can start off with technical analysis from today itself. Because this is such an important video that without this video, technical analysis is impossible. So let's begin with today's video, and I would suggest you to watch this video very carefully and with full focus. And if you have any doubts during the video, don't forget to pause the video and write a comment below, because here you can take an advantage of me and ask me any questions or any doubts that you have with this series. So let's start off with this video, and I hope you enjoy it. So now we come to the first slide. Now in this slide, we'll find out what is trend in technical analysis. So I will read out this entire paragraph, but after that, I would want you guys to pause this video and read this para with your own speed. And after that, I will decode what this paragraph means. So this paragraph says that trend is the most important part of technical analysis, although it is the easiest to understand. But this is one such factor that we always end up mistaking, which leads to a lot of bad trades and positions. The direction in which the price of the asset moves is called trend. Now let's pause the video and read this at your own speed. So now we come to our second slide. Here we'll find out what are the different types of trends. So the first one is called the uptrend. Now we are already aware of the uptrend because in the first video we covered the uptrend with the example of the tomato. So when the price of the stock moves up and in a steady direction, it is called an uptrend. Now, if we talk about downtrend, which you are again aware of because we covered that in the first video with the example of Tata Motors. Similarly, when the price of the stock is falling in a steady direction, it is called a downtrend. So when the downtrend starts, or right before it does, it is ideal to exit or quit a long position. Now we talk about the third point, and the third point is no trend or consolidation. Now this is the trickiest part of trend analysis, and this is where every mistake or error happens. What happens is, in a phase of consolidation or no trend, the stock's price is range bound. So when the price of the stock is range bound or moves within a range or not showing any steady direction either up or down, we call this a phase of no trend or a consolidation. So now let's try to understand these points. So the first point is an uptrend. When a stock price moves in the continuous direction and is going up, we call it an uptrend. And the reason why uptrend is so important is because when you are buying a share, your objective is to enter in an uptrend and sell the share when the price is going up to a certain point. And with the help of the uptrend, we can take an advantage of the price movement and take a position on the lower side and exit on a higher side. So it is very important that we take a position or buy a company's share when the stock is in an uptrend, because your objective is to buy low and sell high. So now we'll see what is an uptrend and how does it look. So the first thing that you have to understand about the stock market is that the price of the stock doesn't move in a straight line. So here the stock will always move in a zigzag pattern or a stair-like pattern. Now on your screen you will see that there's a white line with the prices denoted next to it. You'll see that the price started at 90 and then it went up to 105 in a zigzag pattern. This is called the proper direction of a price movement in the stock market. And now if you see the green colored bar, that is a straight line. The stock will never move in a straight direction over a period of time. It will always follow a zigzag pattern. And this is a very basic concept which you need to put in your head. Now if you study this chart, you will see that the price started off at 90. Then it fell down to 87, then it went to 95, again fell down to 90, then 100, then fell down to 97, and finally went to 105. Now this direction is giving us an idea that the price is increasing continuously over a period of time. So it started off at 90 and then it went to 105. Hence we are calling this an uptrend for this specific share. Our job as a technical analyst is to understand the direction of the price. If the price is going up and is following continuous route, we say it is in an uptrend. Here, if you see, this is a proper description of an uptrend of a share price. Now let me show you a few examples which will clear your concept. So here you'll see a live example of Reliance Industries, and this is a line chart. We'll learn more about line chart in the upcoming videos, but here you'll see that the price started at 1200 rupees and then it continuously went on to 1600 rupees, and the direction of the price was going up. So this is what we call an uptrend in Reliance Industries. Now you will notice that the price of the asset was not in a straight line. It went up at certain points, it fell down at certain points, and then finally it reached a price of 1600. So as a technical analyst, we have to spot this direction, and in the trend analysis video 2.0, which is down the series, you'll find how to draw the trend properly and how to identify it. But right now it is very important that you understand the concept of an uptrend in the stock market. So here is another example of Reliance Industries, and this is a candlestick chart. This is the chart that we will finally use when everything is covered and you have learned everything. And here you will also see that the price started at 1200 rupees and then it went up to 1600 rupees, and the movement of the price was in a zigzag pattern going up. Second point is downtrend. Now similar to the uptrend, here also when the company's share price is in a continuous direction and is falling down, we call it a downtrend. Now the objective of a downtrend is that if you already have a share present with you, then you have to avoid the downtrend. Because if you already hold a share and the price of the asset is falling down, you will make a loss in it. So what we have to do is we have to exit our position when the stock starts a downtrend or right before it starts a downtrend. And this is again a very important point which you have to remember. So now we look at what is a downtrend and how does it look. So similar to the last example which we saw in the uptrend, the price was moving in a zigzag pattern. Here also you'll see that the price is moving in a zigzag pattern, but it is going down. So it started off at 105 and fell down all the way to 90. Now what you have to do before a downtrend starts is you have to exit your long position. Because if you do not exit a position which you already had taken when the stock was in an uptrend, you will end up losing money before a downtrend starts. So the entire concept here is to avoid a downtrend if you have a long position since you're an investor. So let me give you an example which will clear your concept. Now this is a live example of Ashok Leyland and line chart. And here you'll see that the price of the share was at 135 and then the downtrend started and it fell down to a price of 80 levels. So assume that you had bought a share at 100 levels a couple of trading sessions earlier. You should have booked your profits at 135, because if you hadn't booked your profits at 135, the share would have fallen to a level such as 80 and you would have lost 20 rupees per share in profits. Now another example is the candlestick example, because this is the final technical chart that we'll end up studying. So I'm just showing you a snapshot. Here again you can see that the price started off at 135. It fell down in the same zigzag manner to 80 levels. So now we talk about the third point, which is consolidation. So what happens in a consolidation phase or a no trend phase is the stock's price will not show a proper direction. It will neither go up consistently, neither will the price fall down consistently. What that basically means is it will not show us any proper trend. So it might happen that the price of the company on the initial day can be at a certain level, then it went up to a certain level and then fell back to the initial price level. So when this happens, we call this a consolidation phase or a no trend phase. And you have to remember that in a consolidation phase, we should never take an entry, neither should we exit a position in the consolidation phase, because here is a place where we always end up mistaking our position and we might end up losing money. You'll eventually learn how to avoid consolidation phases in the later on videos, but this is right now something that you have to remember. So now we'll look at what is consolidation and how does it look. So this is something that is new and we haven't covered this before. So I would like you guys to pay a bit of attention here because this is very important. Now I would suggest you that if you face any difficulty in understanding this, you can pause the video and see what the diagram is showing you. Now here you'll see that there's this white line which is suggesting that the price of the asset of the past 7 days was range bound. So it started at 88, then it fell down to 84, then it went up to 87 again, fell down to 85, and then again 87, then 82, 90, and then finally 85. So this is the entire past 7 days price list. Now during this period, the stock never crossed the mark of 90 on the upper side and never fell below the mark of 82 in the lower side. So this is a range bound situation, when the price is not showing any positive direction, either going up or going down. And this is one such thing that we end up mistaking a lot, because we sometimes confuse that this is start of a new trend. And you'll learn eventually that this is something that we always end up mistaking. So in the later videos, you'll find out how to correctly identify a consolidation phase. But trust me, if you can identify a consolidation phase, you are a champion trader. So this is a live example of Tata Motors line chart. And here you can see that the price of the asset was range bound for a certain period of time. And here we could see that with the marking of two yellow lines, one on the top and one on the bottom. So the price of this asset went to the highest level of 200 or approximately 200 on the upper side, and on the lower side it went close to 150. So the price of this asset during this entire period never crossed the upper mark or never crossed the lower mark. So this is suggesting that this is a consolidation phase. And like I said, we always have to avoid the consolidation phase, as in we cannot take a fresh position or a new entry during a consolidation phase. So we will not exit a share when the consolidation phase starts. Similarly, we will not buy a share when the consolidation phase is going on. Similarly, if we see the candlestick chart here, you'll see that the price of the stock is again range bound and is in the same price direction, which is marked with the yellow lines on top and the bottom. So let's make this video a bit interactive. Let's check what you have learned so far. So you'll find a box over here. Click on the box and vote the answer that you feel is the correct one, and see what the other market participants are thinking. So now we'll look at the things to consider in trend analysis. Now we'll look at the things to consider in trend analysis. Now I've already taught you the uptrend, the downtrend and the consolidation phase. But there are certain things that you have to consider before you do trend analysis. So the first point is new trend starts after consolidation. In 90% of the cases, a new trend will always start after a phase of consolidation. It can either be an uptrend or a downtrend. So this point says that whenever you see or identify a new trend, it is 90% likely that before the new trend starts, there has to be a phase of consolidation. As in, there will be consolidation first, and after that a new trend will start. The trend can be either an uptrend or a downtrend. Now if we talk about the second point, which says spotting reversals, spotting trends are easy as compared to spotting trend reversals. And if we are able to spot a new trend, half of the work is done. So what this point is trying to say is that when we look at a chart, it is fairly easy for us to see whether the stock is in an uptrend or a downtrend just by looking at the chart. But spotting a reversal is a bit difficult. And if we are able to spot a trend reversal or a new trend, 50% of our work is done. So in the trend analysis video 2.0, which will be down the series, we will teach you how to spot a trend reversal, and that will help you ensure that you are taking the correct position. Now we talk about the third point, which is false movements. One reason we feel spotting a new trend is most likely because there are tons of false signals that we get from the chart. At first, it might look like a new trend, but it ends up being a noise caused by volatility in the market. So this is a very important point. Let's try and understand this in a simple way. So what this point is trying to say is that most of the time you'll see that the stock market is giving us false signals. The reason for that is volatility. Technical analysis' biggest enemy is volatility. If we see volatility in the market, technical analysis is not ideal to use in those situations. So when the market is volatile, what will happen is in the phase of consolidation, you might just end up seeing that the price of the stock is crossing the upper mark, or might also see that the price is falling below the lower mark. As in, the price band of the consolidation phase might be broken because of the volatility in the stock market. So the price might cross the upper price band because the stock's volatility had increased. Similarly, the stock's price might fall below the lower price band because of the volatility. So here, this is one important point which you need to understand, that stock market will always give us volatile movements, and this will create a lot of false movements. And eventually in this video series, you'll learn how to avoid these small movements. But trust me, even if I teach you everything or you learn everything, you will at certain times end up making mistakes. So don't be disheartened. This is just part of the game that we have to get used to. So let's end the video today, and I hope whatever you have learned, you have understood. But if you still have any doubts or queries, quickly go to the comment section and write whatever doubt you have without any hesitation, and I will personally try to answer them. Along with that, don't forget to hit on the like button and subscribe button to our channel to get the latest notification of stock market and investment in general. And don't forget to check out our Facebook and Instagram page, where you'll find the facts and tricks of the stock market. So I'll see you guys in the next video.